What's up, Investomaniacs? Today, I want to talk to you about a concept I call negative risk. This is something I weigh very heavily on my investing decisions as well as my life decisions in general. And it's not something I hear other people talk about very much. So, what is negative risk? Negative risk is the increased probability of not achieving a desired outcome due to not taking on enough risk. This concept can represent many aspects of life, but today we're going to be focusing primarily on investing. Negative risk is not so much an issue if you already have a relatively large portfolio or relatively small goals. For example, if you have a $10 million portfolio and you're happy living off $300,000 a year, you can pretty easily earn 3% post-inflation while not taking on that much risk. This person doesn't need to worry a whole lot about negative risk. But what about the other extreme? What about the person who only has a $5,000 portfolio or a $10,000 portfolio? This person can't just leave the money in their bank or invest in bonds or gold or even the S&P 500. It doesn't provide enough returns to ultimately get the person to where they need to be to have a secure retirement. This person must accept higher levels of risk to give themselves any real shot at achieving a secure retirement. But most people view it as too risky, and they just keep their money in the bank. What they fail to understand is that the bank is not safe. It is safe in the sense of a predetermined outcome. You know the outcome while you're going into it. So in that sense, it's safe. Bonds are safe in that sense. You know the outcome while you go into it. Obviously, assuming the country doesn't fall apart. The S&P 500 is relative to bonds more risky, but relative to some riskier individual securities, it's a lot safer. So it's how much do you know the outcome, right? That's what most people define as risk versus safe. It's what's the probability that I know what's going to happen here. But of course, while we know the outcome of, say, keeping your money in the bank, people still don't care because they want that security even if the security is bad. For example, in 50 years, inflation will have eaten away roughly 78% of your money. So if we know that if you keep your money in the bank, all it does is erode. There is a 100% chance keeping your money in the bank will erode it. After 50 years, you've got about 22 cents left out of every dollar, and yet people still keep their money in the bank because people are risk averse. People like to know the outcome, so they view taking on additional risk, as in not knowing the outcome, they view that as absolute risk, but that is false. That's not how it works in the real world. In the real world, keeping your money in the bank is the riskiest possible thing you can do. In the real world, if you don't have enough money to start out with and you don't have enough money coming in, putting your money in bonds is super, super risky because you're not going to be able to grow that capital enough by the time you retire to have a secure retirement. Obviously, if you have more money or more coming in and you can contribute, that's a different situation. We're talking about those who don't have a whole lot of money. So let's take a look at this distribution curve. We have a steeper, solid black line and then a flatter, dotted red line. The vertical axis, that's up and down, represents the probability of success. And the horizontal axis, that's left and right, represents the level of success, with 0 right here being average levels of success. So the solid black line, that's the conservative investor. He's putting his money into fixed income, market-wide ETFs, blue chip stocks, gold, this type of stuff. There is a very strong chance he'll receive a fair return, let's say 3 to 8% annually. This type of investor could also be, say, a person doing kind of like real estate and stuff like that, right? Just kind of like buy random houses, hold on, you get your 1% appreciation after inflation, right? They're relatively secure bets. Similarly, there is a very small chance that this investor will lose any significant amount of money, and there's also a very small chance that he'll earn any significant amount of money, let's say more than 10% annually. The red line represents the risk-seeking investor. This is the investor of smaller, riskier stocks, or one who trades options or futures, uses margins in the real estate world. This might be your house flipper, etc. This investor has a comparatively much higher probability of achieving extraordinary returns, the 15, 20, 25% plus annual returns, but they also have a much higher probability of achieving extraordinary losses, 5, 10, 15, 20, 25% plus losses. This is the reason why negative risk exists. Because while additional risk increases the probability of achieving a superior outcome, right? The red line, the aggressive investor, higher chance of achieving a really solid income, he also has a higher chance of achieving a really bad income. And people don't like that because people are risk averse. They will choose the safer option, even if that option does not result in the desired outcome. Meaning, if you put your money in knowing what the estimated return is and you get that estimated return, some people will go into it knowing that won't give them enough money, and yet they still do it just because they don't want to take on the risk. So therefore, by risk, I mean the undetermined outcome. So they are accepting additional risk in that they're going into something knowing they're going to come out with not enough money just so they can feel secure about how much not enough money they're going to have. It doesn't make any sense, right? Even the sentence by itself doesn't make any sense. That is the paradox of negative risk. It is the point at which the safe bet becomes the risky bet, meaning the determined, the known bet is the risky bet because the payoff isn't large enough. And similarly, the point at which the risky bet, the unknown outcome, becomes the safer bet because there is at least a possibility that it will result in a high enough of a return or an outcome to give you the desired outcome. Let's take a look at American football as a metaphor. It's the last play of the game. You're on the 50-yard line, you've got possession, and you must score a touchdown to win. What is the correct play? Well, it's pretty obvious, right? A Hail Mary. We all know that. A Hail Mary is the correct decision in that situation. Why? Because despite a Hail Mary having an extremely low completion rate relative to, say, a run or a shorter pass, and the absolute percentage of gaining any amount of yards is much lower with a Hail Mary compared to a run or a shorter pass, in that situation, a Hail Mary has the highest percentage chance of resulting in the only outcome which can actually win the game. Thus, the more risky option, the Hail Mary, becomes the safer option because it has the highest percentage chance of winning the game. So for you, this is investing. What's the end of the game? What's winning the game? It's having enough money for a secure retirement. If we invest in anything which gives us a return lower than that required for our personal situation to achieve a secure retirement, we are taking on negative risk. We are actually putting ourselves in a riskier situation because we're afraid of not knowing the outcome. The way we perceive risk is important. Most people only perceive risk in black and white. They want to know what's the percentage they come out ahead, what's the percentage they come out behind. That's it. I want you to be smarter. I want you to see the shades of gray in risk. I want you to consider not just whether or not you'll succeed and what percentage that will be, but by how much will you succeed? What is the level of success? And is that level enough to get you to where you want to be? And is that level of success enough to satisfy you and make you happy? Hey guys, that's it for this video. Hope you liked it. I'd appreciate a thumbs up and make sure you're subscribed to Investomania, brother.